Okay. All right. So welcome to, we're going to look back on the third quarter just through the market lens, like I typically do on these webinars, just to help us understand what the state of the market is. And then Gina will go into a deeper dive on the model portfolios and the kind of the macro outlook. So let's first take a picture, take a look at the stock market, which, as you can see, is in a very bold, strong uptrend. This is a 2-year look back, and trying to understand, even in the face of all the uncertainty and fear, frankly, around the election process, the market hasn't seemed to be influenced by that at all. And I would just say that the role of the stock market index, such as the S&P 500 that we're looking at now, is to discount or reflect the earnings outlook of these 500 companies that comprise the S&P 500 index. And what's going on, in the backdrop, politics aside, is that the technology boom is very real in terms of AI's applications to just about every aspect of our lives, but particularly in the area of software development, biotech, consumer interface, robotics. Some of you may have already seen these clones right now that are in the marketplace. Like you could actually, if you have enough data, video content, written data, say you're an author of a book, you can put all that into an AI bucket and turn yourself into a full-time avatar out on the internet, interacting with people via email, text, and video. So the applications of AI right now and its impact on improving profit margins is quite high. We'll look at a chart here in a minute about the earnings outlook. But technology, number one, is the driver behind this bull market. And then secondarily, lo and behold, with the Trump election, the belief that he is going to cut corporate income taxes from 21% to a proposed 15%. Now, time will tell whether he actually gets that through, but the market is believing that, in fact, that's coming. And again, what that means for this corporation is that their bottom line profit margin is going to go up. Now, there are other consequences we'll talk about with respect to that tax cut, but the market is perceiving good earnings ahead for stocks and powered by technological innovation in particular. So here's the earnings outlook growth, and that is a little confusing. Just look at the red line. The red line is the 52-week, that's 1 year out, forward earnings per share projection. And that's this number over here, $275 in 2025. EPS stands for earnings per share. That's a 13% growth from 2024 estimated levels. And again, this is very, very strong. The United States stands alone, really, in terms of the growth in earnings in the underlying companies that comprise our stock market indices. And so this factor is really what is behind the bull market that we're living in right now. And it's come with a very interesting twist. If you remember in the the second quarter webinar that we did 3 months ago, if you can see my cursor here, I was showing you a chart of interest rates that was right around in here. Interest rates were on the decline. And I made the point that, from the standpoint of improving the housing market, business investment in plants and equipment, the world of car loans, the world of credit card loans, consumer finance, et cetera, all was being supported by a lower interest rate environment down here. Again, this is a picture of the 10-year government bond interest rate. And that serves as the benchmark against which just about all business lending and mortgages is attached. So this is a really important interest rate. The fact is that the moment we had, if you remember back in September, the Fed cut interest rates by 0.5%, but the Fed only controls what's called the Fed funds rate, which is the overnight lending rate that it charges banks to either borrow money or deposit money with the Fed. The Fed does not control 10-year interest rates. That is a function of the market. So what's fascinating is virtually on the day of the half-point interest rate cut in the Fed funds rate, look here how long-term rates started going straight up. And what the long-term rates, in hindsight, we now know what was going on is the bond market had forecasted a Trump win. And this has come to be called the chaos premium. The bond market is so uncertain about what life will be under a Trump administration that its uncertainty is driving up interest rates. And that is actually not good. This green box that says 4.3% closed today above the downtrend line at 4.45%. So what it means is the new home buyer is facing yet even higher mortgage rates. Car loans are going to be just that much more expensive. If you're a business looking to invest in plant or equipment or expansion, your cost of money has gone up. And further, the interest on the U.S. government debt is going that much more expensive. So this unwelcome rise in interest rates is really going to have profound consequences to the U.S. economy's growth outlook going forward. And I think at this point, the market is still giving the benefit of the doubt to the Trump's proposals for reviving economic growth, but time will certainly tell. And this debt picture is what is really driving this, because at 35 plus trillion, our interest expense now with interest rates climbing like they have is estimated this year to be 892 billion, which is more than the military budget. And if rates continue to hold up in these levels, that number is just going to go up, which means less available capital for the private economy. And here's the prayer and the hope. This innovation index just basically is showing the technological improvements and efficiency improvements that are showing up in business, not just in the United States, but across the globe due to advances in technology. And we can, basically outrun, elevated debt levels if, in fact, we can develop business solutions that are profitable and serve humanity. If we can keep that innovation cycle going strong enough, we actually can show net new growth, improvement in wages, etc. Time will tell whether we can outrun that debt shadow, but the innovation index is a good thing to watch relative to the opportunity for further growth in the stock market indices. And I wanted to bring up in particular the gold market, which is also showing, this is a chart of gold for the last 1 year, which is showing that between the interest rate chart I showed you and this gold chart, the market is telling us that it is very uncertain about whether Trump is going to be able to manage the affairs of the United States well or not. So you can see that those who are loaning us money from abroad are demanding a higher interest rate. Those who are concerned about instability are also adding gold to their portfolios as a hedge, as a stabilizer. So the market's message is, on the one hand, new highs in stock market, but on the other hand, they're driving up interest rates and gold prices. So you can see it's not by any means a clear endorsement of the Trump administration's policies. There's definitely a lot of caution built into it.
We are expecting, as Stuart said, some major upheaval ahead. And what Stuart and we met with our economist and a whole larger group of impact advisors that we work with. And the whole thinking around what we do is in pacing. And so we're making some shorter term moves right now, but we're going to be making some longer term moves as things unfold. One of the big things that we wanted to watch for was what the Senate was going to do in picking a leader. They picked a less extreme leader who may put some pressure against Trump. And so we're thinking that might be a good thing. And we made some big changes last year. We moved towards more large company stocks out of some of the smaller company stocks and out of some of the renewable energy stocks, because while interest rates were high, the renewable energy sector was really suffering. And that put us back on a trajectory of being more in line with the risk tolerance, the expectations of the indexes. So we compare our portfolio performance to what the standard market rates are doing and what a blended portfolio with the same risk tolerance is doing. And so that's put us in better shape. We do still have some small company renewable stocks in place, mostly in ETF now, so we can be diversified. And we're using that as a place to rebalance. And we'll get more in the renewable energy sector as we go here. But one of the things that we wanted to talk about is what's going to be the easiest things for Trump to implement, what are going to be harder things for him to implement, and what are going to be really, really difficult. Like, we have to reshape some of the fundamental pieces of our government in order to do. The easiest things are going to be the executive orders, which include rolling back environmental regulations, other types of regulations, immigration restrictions, border restrictions. The Schedule F for federal employees, there have been some moves made to try and protect some of the status of employees and put them in a different category so they wouldn't be affected by a Schedule F. That could be changed back, but hopefully the Senate would push back on some of that. And withdrawal from international climate agreements would be well within his purview. The things that would be harder, but probably not unlikely, are the tax cuts and tax reform, deregulation, which is always a favorite of those on that side, restructuring, or mostly defunding of agencies. So we're expecting that he's going to lower funding for the agencies that he's targeted and that the group of them have targeted, and the tariffs and changing trade policies. He's going to need 60 votes in the Senate unless they decide to change the filibuster rule. There are at least 3 senators that have on the Republican side that have really shown an unwillingness to change the filibuster rule. So that keeps power in the hands of a few Democrats for extreme changes. And that's why we're expecting some policies are going to be very, very hard for them to pass. It include eliminating agencies, fully repealing the Affordable Care Act. They just don't have the vote that anymore. The termination of renewable energy incentives. There are a number of Republicans that have already sent a letter out saying that they don't want the incentives to be back, in part because red states are benefiting more than blue states from the Inflation Reduction Act and all of the incentives that are out there. Overhaul of Social Security is very unlikely. Repeal of the Inflation Reduction Act, they're more likely to redirect funding, change some of the funding objectives rather than repealing it completely. Withdrawing from international climate agreements completely. The 20% tariff is unlikely, mostly because there are powers that be that would be very, very impacted. So think lobby and Walmart and some of those discount retailers would very, very negatively impacted by a 20% tariff. The ideological screenings, the kind of we're going to hunt for the people that don't agree with us kind of things, that would take a true fascist overhaul of the government that luckily we still have some senators that we don't think are going to be behind that. And renewables after the election, we're thinking that there's going to be a lot of market volatility. Right now, we're seeing that renewable energy stocks have really come down. The reduction in federal incentives at the federal level, there's going to be a reduction. We're thinking at the state and the level, a lot of those incentives are not going to go away because they're mostly in the blue states, and those blue states have been kind of gearing up to protect them at the state level. And so we're also thinking that there's going to be some private sector investment that will continue and maybe even, lean in now because we've got some impact investors and some people that are pushing for this change happen. We do think that solar is likely to pull ahead of wind. Wind has a lot more challenges economically and environmentally. And so it's going to be easier for the solar industry to off. It's also more cost competitive. And so while we're seeing, the re-engagement with nuclear energy, that's very, very long-term and very expensive. Solar is much faster to put up and much more cost competitive. A lot of energy storage projects, so battery storage, they're in the works, and it's unlikely for those things to be discontinued, in part because of AI and AI's need for a huge amount of energy. And so we think that's going to continue forward. Portfolio changes, we're going to lessen our gold a little bit just because we've seen such a huge rise in gold, and we overweighted gold and silver when Putin went into Ukraine. And so we're going to take advantage of that and take some of the profits there. We're expecting inflation to continue to be a problem, and so we are managing the bonds in that direction. We're looking at real estate. We're moving away from farmland and real estate because there's a target on the farmer supports. Even though they voted for him, he doesn't like supporting farmland. So we're moving more in the direction of medical and logistics real estate. All of that with a screening of real estate trusts that are also engaging in energy efficiency and adding renewables and being thoughtful about how they're caring for the planet. So it's not an all out. We're moving out of marijuana completely because the Project 2025 folks are very against. And so we're mostly making the early changes of what we can see right now. There are going to be some longer term changes ahead. I think the other thing that we're going to want to talk to clients about on an individual level is if your future plans are really dependent on the market performing fairly consistently in the next 5 to 10 years, we want you to consider annuities. And the reason for that is because annuities have some protections and guaranteed results that we're not thinking the market might be able to perform in the same way. Depending on if, Musk gets in there and is able to fire a ton of federal workers, tariffs are able to be implemented at bigger rates, there could be a lot of economic upheaval that impacts the market. And large international life insurance companies that do run annuities have the ability to weather those storms a little bit better than those of us that are just in the stock market directly. So reach out to us. That's a concern of yours. I think that's everything for me. I hand it off to Annalisa now.
That was a lot. Thank you, Gina. Thank you, Stuart. And I just want to say it's really great to see everybody here today. We wanted to talk about transitions in the face of the upcoming change, because as an individual, the way we respond to the change affects our ability to be logical and clear in making decisions for the future, whether that's financial or otherwise. So this model that you're looking at right now is a metaphor for 4 stages of change. It's fairly self-explanatory. We can easily apply this to the election that we've been in anticipation stage for a long time regarding the election and potential transfer of power. The ending we can call when we actually transition to the new president, but we're in the process of ending right now, having just had the election. And then the passage stage typically takes quite a few years to reestablish what the new direction of our life is going to be as a result of that transition. So one thing to understand about change is that change is situational, as opposed to transition is how we internalize that process of change, what we do with it, how we respond. And it's an opportunity to remake ourselves. And as we know, change is highly disruptive. And the way we respond, how do I want to put this? We need to find our anchors in order to respond without getting derailed. And one way to look at that is like getting on the balcony. If you imagine a big dance hall, ballroom, and everybody's dancing and swirling around and moving and maybe bumping into each other and they're sweaty and whatever, as opposed to if you're up on the balcony level, you can see bigger patterns. You can see a bigger dynamic. And so I would invite you to think about getting on the balcony level of your own life. What is the bigger pattern here? What are the bigger elements in your life that anchor you? Whether that is a sense of purpose and priority in your life, whether it's religious, whether it's meditating and experiencing a sense of expanded consciousness and expanded universe, or is it a commitment to your community, to your family? Find those pieces in your life that are grounding. And from that place, if you can shift your mental attitude and lean into the challenge that this new change is offering, it literally becomes less stressful on your body. We know that from science, that leaning into a challenge with the attitude of anticipation. What am I going to do about this? How am I going to address this situation in a way that is meaningful to my life? We also know from science that being in nature, taking good exercise, whether that's walking or working out or dancing, anything to get the endorphins going in your body, that will really help with lifting you up. And then also finding your support group. Finding people in your community or in your family, going to a health professional if you need to, finding people who can give you inspiration and give you a sense of stability. And I wanted also to read to you the 5 primary values that anchor centered wealth that we've actually been working on over the last 5 years. Just to let you know, like, we've been working on these pieces too. And so the first is a collaborative approach to cultivate patience, clear communication, and generosity. The second is conscientious care to mindfully support clients with efficient, systematized processes in service of a meaningful experience. The third is creative optimism to embrace change with a spirit of curiosity and inner resilience. The fourth is connected community to build trusting, inclusive relationships through self-awareness, accountability, and empathy. And the last principle is commitment to right action, co-creating a world of justice, peace, and well-being for all. And so with that, I want to thank you all for being part of this journey and let you know that we're here to work with you on an individual basis, not just on your finances, but as a thought coach as you navigate the transitions of your life and the greater life.
Yeah.
Mm-hmm.
I also wanted to just add one pragmatic thing. Please reach out to us for planning, life planning. I know people are feeling like they're in upheaval and they might need to make some changes on this, or, we are here to work through the pragmatic issues, not just the, big picture market kind of issues, but actually your life planning and how you want to move forward with this. And so reach out to us if you want to walk through anything together. Don't feel like you have to face changes alone. We're in this together.